Right, guys, welcome. Yong here. We'll be sharing with you for today's webinar. Right, so really excited and thank you CMC for inviting me to be part of this webinar. If you can hear me loud and clear, okay, I would like to have some response from you guys. Just put it one on the chat box so that I know that the audio is all good. You'll be able to also see my webcam as well as the screen sharing. Okay, so if you guys can hear me, just put one in the chat so that I know that we are good to go. Okay, and of course, throughout this webinar is going to be quite interactive, so I would like all of you to participate in the chat. Okay, so if you can hear me loud and clear, put a 1 in the chat so that I know we are good to go. Cool. All right. Okay, so we can get started. So today's topic will be on practical technical analysis for short-term trading. Okay, so what I'm going to share with you today is really based on what I'm personally using to trade the financial market. So a very quick one about myself and of course some of the objectives that we're going to cover in this 1-hour webinar over here. Okay, really appreciate that you guys put in the time and commitment to join us in this live webinar. So I'll make sure that throughout this 1.5 hours of webinar, I'll give my very best, and of course, it's going to be very interactive. So at any point in time, if you have any questions, right, we'll have a Q&A session at the back. So do write your questions down, and we'll address all of them before we end off this webinar. Okay, so today's objective is quite simple, quite clear-cut. Number one is, of course, we're going to share with you how you can actually analyze and forecast the market with high accuracy, and eventually, of course, as a result, you'll be able to profit confidently from the financial market. Okay, this technique here is something that you can apply to any financial market that has a chart, right? That's why it's called practical technical analysis, which means that if you are looking at currency market, you can apply that. If you are looking at indices, commodities, or even individual stock market, this technique that I'm going to share with you today can be applied into those markets as well. Okay, the second thing is, of course, as what I like to do, right? Every time I do a webinar, I like to share some live analysis. And of course, sharing with you some of the potential trade opportunities that I'm personally monitoring for the remaining of August, which is 2 more weeks, right? And of course, for the following month as well. Okay, but having said that, right, a very quick disclaimer is that if you are trading the financial market, right, naturally you need to understand there are risks involved, and you need to have a proper plan. Okay, so today's sharing is really based on what I'm personally doing. Okay, and of course, the last one here is to make sure that you gain the most from this webinar. Okay, so we'll have a Q&A session at the end, and I want to make sure that you actually put in the time to be with us here today. So I want to make sure that by the end of today's webinar, you get everything clear off. Okay. So a quick one about myself. My name is Yong, right? So I'm pretty active on social media. You can follow me on Facebook or Instagram. And a very quick backstory about me in trading is I got started in 2012. Okay, and in the past I was very active in Singapore as well. But right now with MCO and everything, I'm actually back in Malaysia. And right now we're still able to do this because of internet, right? So that's great. Okay, so I started my trading journey in 2012, and I transit being a full-time trader in 2015. So from 2015 until today, I'm basically full-time trading and investing, and very fortunate that I'm having this opportunity, right, invited by CMC to share with you my experience and of course how I analyze the market. Hopefully we'll be able to inspire some of you guys and to give you some insights as well. Okay, so throughout the years, I've been traveling around Southeast Asia, right, to share my experience, my journey of trading to students or even adults who are interested to trade and invest. And I always preach that it's very important to manage risks. Okay, if today you're very new to trading, take it slow. That's something that I would say always focus on risk management. Okay, and of course, I want to also share with you my journey. Okay, so that you know what I'm going to share with you in this webinar is very practical, something that I personally use. So there's no theory and concepts. They are really stuff that I use for my own trading. Okay, so this is a quick journey about myself in 2019, my journey of trading. It was a very easy year, right? Last year was fairly easy. I managed to take from the market about 30 to 40% in total for the year. But I want to be very transparent as well with you guys and honest. You can see over here, 2020 is not that easy, right? It's not that smooth sailing. Okay, and this is my journey in the currency market. So you can see this year is really tough. There are some drawdowns, and of course, the profit isn't really that great as well. Okay, but again, I always emphasize risk management is very crucial, right? And of course, some of you who are more perhaps interested into stocks, commodities, or indices, right? The technique that we're gonna share about today applies on it as well, right? So this is actually my stock portfolio. And of course, this year, if you are very active in the financial market, you know that the stocks and commodities portfolio is fairly easy, right? In 2020, especially if you are looking at gold and silver, right? Those are like easy, right? It's just going straight up. Hey, so why I'm sharing with you all this is really to give you that idea that you know, this stuff that we're going to talk about in this webinar is practical. Okay, so it's not really something theory. So I hope you pay attention, be present in this webinar anyway, since you decided to commit that 1.5 hours with us, right? So I want you to be present, and I want to hopefully, you know, you gain as much as possible from this webinar. Okay, so let's dive straight into the content for today. The first thing I want to really walk all of you through is the understanding of how to look at technical charts. Okay, so this one here is some of the common mistakes that I see many beginners traders does is that they tend to go and study a lot of various indicators, and their charts are very cluttered. Okay, so they stack up a lot of different indicators, thinking that the more indicators they use, the higher accuracy and probability they're gonna get. Okay, but today, what I want to really bring all of us into understanding is, if today you look at technical indicators, right, all of them essentially comes from price itself. Okay, all those indicators are basically just formulas, mathematical formulas calculating the movement of price. Okay, and that's how the indicators are formed. So instead of looking at a derivation of price, which is the indicators, right? Why not straight away we actually understand and look into the price chart directly? Okay, so this is a part where some traders might get very confusing when they look into charts and such. Okay, but today my key objective here is to make it very simple yet efficient and effective for all of us over here. Okay, so if you look at any price chart, okay, any technical charts that you pull out, doesn't matter what instrument it is, okay, there are only two ways that price can move. Okay, of course, these two ways is not up and down, right? But these two ways here, I'm categorizing it as impulse and correction. Okay, so in a moment, I'm going to share with you the definition of these two. Okay, at the same time, I'm going to show you some charts so that you understand what is impulse, what is correction. Okay, and of course, right, I hope that you guys have some paper and pen to write down notes. Okay, the slides will be given to you at the end of this webinar as well. Okay, so but at the same time, I want you to write down notes, right? So impulse and correction are essentially the only two ways price can move. Okay, so what is an impulse? Impulse basically indicate a very strong directional move. So it can be going up, it can be coming down, but either way, right? If price is going in a very strong and fast move in one particular direction, we categorize that move as an impulse. Okay, so words that we use to describe an impulse include like high in momentum, huge momentum, or very fast, or you see a very huge candle, right? So those are all impulses. Okay, and of course the opposite is correction, which means that the price is very slow. There isn't any clear direction. Okay, so it's going sideways. Those are called correction. Okay, so over here, if today you are still very new, okay, to these terms are actually the principles and building blocks of Elliott wave. Okay, but again, today we won't go into the very complex stuff of Elliott wave, but I want you to know that these principles are actually adopted from Elliott wave, and to me that is one of the most effective way to analyze a technical chart. Okay, so this chart, this slide here actually illustrate what is impulse, what is correction very clearly. Okay, so you can see the red color boxes that are highlighted, those are impulse move. Okay, so in this case, the example of this impulse is coming down. Okay, but it can also be going up, right? So in this case here, it's coming down. Why we highlight those red color and we call them impulses? Number one, okay, the direction of that move is very clear, is moving down. Number two, you can visually also identify that the move is very fast, okay, which means that the time duration it took for price to move and cover a certain distance is very quick. Okay, so those are what we call high momentum, right? Very huge in momentum. So those are impulse move. The opposite is the corrective one, which is the one that I've highlighted in blue, right? They're both basically going sideways. Okay, so in this chart here, very clearly you can see the differentiation between what's impulse, what is correction. Okay, now at this point in time, the one thing I want all of you to really understand and being able to differentiate what is impulse and correction. If today, after attending the entire webinar and all you can take away is how to differentiate impulse and correction, I can tell you this skill that you have, the ability to differentiate this is already very powerful. Okay, so don't look down on this simple concepts and principles. And I would want all of you to practice this, right? So I'll have some activities for you guys to practice. Okay, so let's take a look at some example and then we'll go into practice. So I want to make sure all of you understand the principles, how to differentiate it, and I want all of you, at least majority of you, get it right. Okay, and then we can move along together into the next segment, right? So over here, more examples to show you, right? So if you start from the bottom left of the chart, okay, you saw that move to the upside, that is pretty clear cut. That is an impulse move. Okay, so I highlighted that in light blue. That is very clear. Okay, the momentum to the upside is very strong. Okay, and for that, we actually categorize that as an impulse. Okay. Then subsequently, what we saw is price starts to slow down, right? It starts to come back down, but it doesn't go down very fast. Instead, it starts to form what we call a sideways movement. Okay, so there's no clear direction. The momentum is very slow. That itself is a correction. Okay, following that, you can see the next move to the upside. It's fast, right? It's relatively, the momentum is bigger. The direction is super clear. It's going up. Okay, so that itself is an impulse move. Okay, so in this part here, you see you have an impulse, correction, impulse. Okay, so don't confuse yourself first. Up to now, I want you to be able to differentiate whether one move is impulse or correction. Okay, and of course, subsequently, the move starts to come down a little bit. You realize that it's pretty slow relative to the previous move, right? So that is to consider a correction, and the last move over here, that's an impulse back to the upside. Okay, to give you more example, okay, some of the charts might be clearer, some of the charts might be a little bit more challenging. Okay, but that's part of trading. Okay, so at the end of the day, I want you to be able to identify what is impulse, what is correction. Okay, now over here, this is another example. You can see if you start from the left side of the chart, the first push to the upside is pretty strong in momentum. Okay, so that's an impulse, and then after that, it forms a correction, right? It starts to go sideways, it's not going anywhere, it's slow. That's a correction, and subsequently, it's another impulse move to the upside. Okay, and after that, we almost instantly saw the reaction where price comes back down very fast. Okay, so that's also an impulse. Okay, so again, I don't want you to confuse yourself right now in terms of, oh, after an impulse, do I see a correction, or after an impulse, what do I see? Okay, right now, I want all of us to be very clear how to differentiate impulse and correction. There's no direction in between impulse and correction. The idea here is impulse are fast moving, momentum very high, okay, and correction, they are basically slow. That's the description of impulse and correction. Okay, and of course, the last piece of this chart on the right-hand side, you can see the entire move itself is actually a correction. Okay, it's very slow, okay, and it's not going anywhere. And one of the things that you probably can identify on the right side of this chart over here is that it's a lot of overlapping. Okay, in a very colloquial layman term, right? I call it ding dong. Okay, so ding dong meaning it goes up, comes down, goes up, comes down. It's not going anywhere, right? So that is what we meant by correction as well. Okay, so that's the characteristics of correction. Okay, so I hope with these two examples, you guys get a much clearer understanding of what is impulse and correction. Okay, so over here, I want all of you to practice. Okay, this is very important because if you just listen to me when I'm presenting, and then I walk you through, oh, this is impulse, this is correction, it might seem easy. Okay, but I want you to practice. I want to give you this opportunity in this webinar, throughout this webinar, to actually practice, participate, so that you actually acquire the skill right at the end of this webinar. Okay, so over here, very simple. Okay, any chart we look at, there's only two types of move, right? So what's going to happen is that I'm going to highlight a portion of the chart, okay, and I want all of you to actually identify, okay, whether this highlighted portion is an impulse or a correction. Okay, so all I need you all to do is really to make full use of the chat on this GoToWebinar, right? So you can actually find the chat box on the right hand side of the screen. Okay, so if this highlighted area, if you analyze the chart and you see that, okay, this is an impulse, okay, I want you to type in an I. Okay, if you look at this portion of the highlighted chart and you think that this is a correction, then you put in a C. Okay, so I want you all to practice on it. Now, if some of you having some technical difficulties on finding that chat, okay, at least I want you to mentally still practice. Okay, that means look at it, okay, mentally decide, is this an impulse or is this a correction? Okay, at least then you know later on, if you have some questions, some things that you want to clarify, you can ask me. Okay, so good. Okay, so I'll give you a quick few seconds, right? This highlighted area, if you think this is an impulse, just make a decision, or make a decision, okay, this is impulse, or if this is a correction, then make a decision on that. Okay, so quick few seconds. Good. Okay, so I believe this is pretty easy. Okay, most of you should in fact get this correct. Okay, so this move is an impulse. Okay, the move to the upside is very fast, so that is an impulse move. Okay, now what about this second portion over here? Okay, is this an impulse or is this a correction? Okay, so same thing, I want you to, within that few seconds, quickly make a decision if this is an impulse move or is it a correction. Okay, now if you actually decided that this is a correction, okay, you are correct. Okay, why? Because the move itself is just going sideways, it's not moving in any particular direction very clearly. Okay, it's ding-donging. That is a correction. Okay, what about this one? Okay, so this one here, pretty straightforward. Okay, again, within that few seconds, you can make a decision if this is an impulse or correction. Okay, so this, most of you, in fact, every one of you in this webinar now should be able to say that this is an impulse, very clear cut. Okay, the momentum to the upside is very strong, so that is an impulse. Okay, and the last piece over here. Okay, so over here, this one you can see price is the direction, the price is still going up. Okay, but I want you to ask yourself this question, right? While price is going up, okay, is it going up in a very fast and strong momentum, or is it starting to slow down? Okay, which means it starts to lose its momentum while it's going up. Okay, so again, the definition of impulse and correction is very straightforward. An impulse is high momentum, very strong in momentum. Okay, correction is basically slow. Okay, so if today you look at this piece of the last piece on this chart, right, you realize that while it's going up, it's definitely going up in a much slower pace, right? And for that reason, okay, this one here, we will categorize it as a correction. Okay, again, it's going up very slow, there's no momentum, it's a correction. Okay, so another chart, all right, for more practices, okay, I want to make sure all of you actually get this. Then we can move on to the next segment. Okay, the next segment, after you can identify impulse correction, the next segment is going to be very powerful. Okay, same thing. If you look at this one, this portion where I highlighted the chart, right? Within that few seconds, you'll be able to decide whether it's an impulse and correction. And if you say it's an impulse, right, you are correct. Okay, again, why? Because the move to the upside is very, very strong. Okay, the momentum is very clear, the direction is very clear, it's an impulse. Okay, this is the next piece, right? So you can see over here, this is exactly what I describe as ding dong. Okay, ding dong. Okay, again, whether it's an impulse correction, within that few seconds, you guys should be able to make that decision. Okay, so this is a correction. Okay, why? Because again, price is just going up, down, up, down, up, down. It's not going anywhere. It's going sideways. There's no momentum, and it's basically ding-donging, right? Up and down, up and down, up and down. So this is a correction. The last one here on this chart, right? This move down. This is very clear. Okay, all of you should be able to get this as an impulse. The momentum is super clear. The direction is super clear. Is an impulse. Okay, so this is fairly easy, and of course, the last piece over here wouldn't be difficult by now. So okay, so if you get this last piece as a correction, right, you are correct. Okay, so it's really slowing down. It's not going anywhere. It's sideways. It's no momentum. That's a correction. Good. Okay, so I hope up to now, all of you will be able to identify what's impulse and correction. Okay, so this little technique, when you look at the chart, doesn't matter what time frame. Okay, you can look at it on a weekly chart, you can look at it on a daily, 4-hour, 1-hour, or even down to the 5-minute chart. This principle of impulse and correction applies. Okay, later when we go on the live chart, I can show you. Doesn't matter what time frame you look at, those principles of impulse correction applies. Okay, now if you can identify and differentiate what is impulse, what is correction, okay, this portion here is going to be very, very powerful. Okay, but of course you need to be very clear how to differentiate impulse and correction. Now once you're able to do that, right, the next step is where when you look at a technical chart right now, you'll be able to establish what we call a directional bias. Okay, so in trading, you need to get two things right to profit, to make money. Okay, the first thing you need to get it right is of course the direction. Okay, if today you don't get the direction right, then very difficult to actually profit from trading. The second thing you need to get it right is the timing. Okay, because we are trading, we are not like long-term investor, right? So if today you don't get the timing right, then likely that trade is gonna end up with a stop loss. Okay, it's gonna end up with a small loss. Okay, so with a technical chart, right now you'll be able to identify and differentiate impulse and correction. This can bring you to the next step where you can identify your directional bias. Okay, so over here, a very quick, simple principles to understand, okay, is that impulse wave provide us with a recent directional bias. In other words, okay, if you look at the technical chart, doesn't matter what time frame, if the most recent impulse that you see, okay, is going to the upside, so the impulse is to the upside, then your recent directional bias should be to follow that momentum, which means that you are interested to be buying, you're bullish. Okay, vice versa, if the impulse is to the downside and what you want to be looking out for is your direction is going to be bearish, you want to look for sell opportunities. Okay, so what we want is we prefer to trade with the direction of the impulse, so we follow the momentum of it. Okay, and right now, because you have the ability to differentiate what's impulse and correction, right, I want you to then see that these two are like your puzzle pieces. Okay, so you have your impulse puzzle and you have your correction puzzle, and of course impulse, you have two versions of it, right? One is up impulse, one is down impulse. Correction, you also have two versions of it. One is correcting to the upside very slow, the other is correcting to the downside very slow. Now, if you have 4 pieces in total, 4 variations, you mix and match them, okay, there are generally 3 combinations you're gonna get, okay, and these are the only 3, okay. So again, why when you understand all this and you apply them onto a chart, okay, and analyzing a technical chart is not that difficult. Okay, so over here, let me share with you this 3 and then we'll go into the details of it. Okay, so the first combination, okay, again, if you have your pen and paper, I want you to write this down so that you take notes, okay, so that will help you to really concretize your learning today. Okay, so the first combination here is impulse, then correction. Okay, so if you imagine, we basically take an impulse piece plus a correction piece, so we put 2 pieces together. Okay, so that's one type of combination, impulse correction. The other combination we can get is impulse. Okay, so basically you take 2 impulses, you put them together. And of course, the last one here is called impulse then crawl. Okay, this one, there's a slight difference between impulse and correction. We'll go into the details in the next few slides. Okay, but I want you to know that with the impulse and correction principle, there are only 3 combinations, and these are the 3. Okay, so let's take a look at what is the detail of this 3 different combination. Okay, so let's discuss the first one first, which is impulse then correction. Okay, so what we do is we take an impulse move plus and combine it with another corrective move. Okay, so over here in this illustration at the bottom of the slide, you can see, okay, the impulse move to the upside, and then after that it starts to form a correction, basically going sideways. Okay, now every time we see a combination like that, okay, we have a very clear directional bias. Every time we see a combination like that, we know there are high probability, about 60 to 70% of the time, whenever you see this combination, the next move, there's a very high chance is going to continue to the upside. Okay, that's why follow the previous impulse. Okay, in other words, if you see this combination, an impulse then correction combination, you want to be bullish, you want to be focusing on buy opportunities. Okay, and vice versa, of course, you have another side of it, right? So the impulse is to the downside, and then you combine it with a correction going sideways. Every time you see this combination, you know 60 to 70% of the time, you know there's a high chance this will continue to the downside. Okay, in other words, if you see something like this on the right, you want to focus on sell opportunities. Okay, so this first combination very clear cut. Whenever you see something like this on the chart, you have a potential trade opportunity with a very high probability direction of getting it right. Now, the second combination, okay, is what we call impulse. In a very layman term, I call this a V-shaped formation. Why? Because if you look at the chart, it looks like a V shape or an inverted V. Okay, so every time you see this combination, I would always suggest to traders, don't trade. Okay, don't trade. Why? Because you don't have an extra edge. You don't have a probability of knowing where is a higher chance where price will move. Okay, so in other words, you don't have any chance, you don't have any edge in winning. Okay, so stay out of the market whenever you see an impulse move. Basically, you see a V shape or an inverted V, just stay out. Okay, be patient, wait for the price to develop first. Okay, and so this is very clear cut. And the last one, okay, the last combination is impulse then crawl. Okay, so this is the part where some of you might get confused and you start to have questions like, so what's the difference between impulse and correction versus impulse then crawl? Okay, so the slight difference here is that if you look at this chart, okay, impulse then crawl, I always use an example of climbing a mountain to describe this combination. Okay, so imagine today we all go and climb hiking, right? We go and climb mountain. Okay, at the very start of the journey, we're going to be very excited. We are full of energy. Okay, and we're going to start climbing with a faster pace. Okay, we're going to go up the mountain at a faster pace, right? And that's your impulse push. Okay, so at the start, price goes up very fast. Now, as you start to climb higher and higher, you start to lose some energy, you know, oxygen level starts to come down a little bit. You start to tire off, okay, and you eventually climb slower and slower and slower. Okay, if you put the context into the price market, right, what it means is that initially there's a lot of momentum for price to push to the upside. As it continues higher and higher, less and less momentum. Okay, so what happens is price starts to form a slower move to the upside. Okay, so this is what we call crawl. Okay, so it's like imagine there's no more energy, but you're still trying to go up, so you are crawling to the upside. Okay, now every time you see a combination like that, right, naturally the higher tendency or probability of where price will likely go in the future is of course a reversal. So if you look at this, right, impulse to the upside, and then it starts to crawl to the upside, no more momentum, no more energy to the upside, very high chance it will come back down. Okay, so if you're looking at a chart and you spotted a combination of impulse then crawl, then you are looking for the reversal. Okay, of course, you have the other direction as well, which is similar. Okay, the idea here is price comes down as an impulse very fast, and it starts to crawl, which means it lacks the momentum to continue to the downside. Every time you see this, there's a high chance it will reverse to the upside. Okay, so again, I want all of you to understand, right? These principles, this combination here, they are not 100% all the time. Okay, there's no such thing in the financial market. Okay, but what we need as traders is again high probability. If today you have about 60 to 70% of the time getting it right, that will be already a very, very good way for you to actually leverage and take full use and opportunity from the financial market. Okay, now based on this, right, there's only this three combination, because again, price can only move either as an impulse or correction, and if you mix and match them, these are the only three combinations you're gonna get from any chart, any instrument, okay, any time frame. So in a while, okay, I'm going to show you some example, and then we're going to go into some live charts to show you all these principles, how is it being applied directly into a live market. Any example, right, that you guys would like to look at, to analyze, feel free to let me know as well. Okay, so let me show you some example first in terms of this combination. Okay, these are charts that I use as well, right? So you look at this. This is actually a combination of impulse then correction. Okay, again, the impulse is to the upside, and then it starts to go sideways. So every time we see this, we know, okay, there's a high probability that price is going to continue to the upside. Okay, because I know this combination, there's a 60 to 70% chance is going to continue to the upside. Okay, and this is what happened next. Okay, and if some of you are quick enough to identify, right, you realize that whenever you get a combination of impulse correction, the next move when it's going to go up is going to go up fast. Okay, and that to us as traders is important, because if today you want to buy into a trade, you want to enter a buy trade, right, you want that short period, in that very short period of time, the buy trade of yours becomes a profitable one. Okay, and you realize that based on this way of analyzing the chart, okay, whenever you got into a buy, the next move, if it's an impulse move, it's going to be very easy to manage, because immediately in that short period of time, that trade is profitable. And I'll give you another example. This is an impulse correction example as well. You see that price is coming down very fast, and then after that, it starts to go sideways. It's very slow. That's a correction. We know every time we see this, there's a 60 to 70% chance the next move is going to continue to the downside. Okay, and that's what happened. Okay, so impulse to the downside. Okay, so this combination can come in variation of size as well. Some of it are bigger, some of it are smaller. So this one here, you can see this is smaller. Okay, so an impulse, a small impulse push, and then after that it goes sideways. So same thing, it's still a combination of impulse correction. You know that there's a high chance this will continue the downside, and if it's continuing to form this combination of impulse correction, then you know, okay, the direction is still the same. It can still continue to the downside, and that's exactly what happened. Okay, so it can come in variation of forms. Now, to show you some example of impulse then crawl. Okay, so this is how it looks like on the chart. Again, the variation of it might be slightly different, but generally it looks like that. Okay, so you have the impulse push to the upside, and then after that it starts to go up slower. That's a correction, and we know every time we see this combination, there's a 60 to 70% probability that the price will reverse to the downside. Okay, and we'll be looking for shorting opportunities, and this is what happened. Okay, that reverse to the downside is quick and fast as well. Right, and of course you have the opposite direction, right? So this is an impulse to the downside, and then the crawl continue to the downside. Every time you see this 60 to 70% chance, it will reverse to the upside. So we are looking for buy opportunities every time we see this combination, and that's what happened. Okay, so again, these are some examples. What I want to give you guys again, some practice opportunity, right? So before we go into a live chart, I want you to practice a little bit. Okay, to give you some kind of like opportunities to put in place and apply what we just covered. Okay, so very quickly to share with you some tip, right? A lot of people, when they look at the chart, they get confused and they say that, you know, how much data, historical data should I look at? Now, if today you understand the principles of impulse correction and you already understand how to look at them in terms of combination, all you really need, right, at the very start, within that few seconds to make a decision whether you want to trade or not, whether there's a direction to trade or not, right? All you need is really just the right side of the chart, okay? Which means all you need is just identify whether there's a clear combination. If there's a clear combination, that is a direction you can trade. If there's no clear combination, don't trade. Okay, so again, that's a tip for all of you, right? You don't really need to look at like a lot of historical data. All you really need is the recent price movement. What is it doing? Okay, now again, doesn't matter what instrument, right? You realize that this example here, I've already taken out the example of what instrument it is. I also taken out the time frame. Again, doesn't matter, because what we are interested at is what combination is the chart telling us. Okay, this can be 5 minutes, this can be 1 hour, 4 hour, daily, doesn't matter. Okay, now if you look at this chart here, okay, I want you to apply what we went through so far, okay, and quickly make a decision whether when you look at this chart, would you be more interested in buying or would you be more interested in selling? Okay, or you can also make the decision and say that, okay, this is not clear, I don't want to trade. Okay, so generally there are 3 decisions a trader can make: buy, sell, no trade, right? So I want to give you that few seconds to make that decision. Okay, again, I want you to perhaps write it down, record it down somewhere so that you know. Okay, we have a few examples. You know, overall, are you getting it right or most of it is wrong? Okay, and maybe you have some things you want to clarify at the end of this webinar. By all means, do that. Good. Okay, so I want you to make a decision: buy, sell, or no trade. Okay, just based on looking at this chart. No indicators, don't need anything. Right now, I believe if you pay attention, and focus throughout the webinar since we started, it's not going to be difficult. Okay, most of you should actually come to the conclusion that when you look at this chart, you would rather focus on sell opportunity, selling it. Why? Okay, again, look at the right side of the chart, right? What is it telling us? It's an impulse correction combination. Okay, so it looks something like this. Very similar, right? An impulse move to the downside and then a correction to the sideways. We know 60 to 70% of the time, every time we see this, high chance is going to continue downside, right? And this is what happened. Okay, impulse down next. Okay, and of course, this is oil chart if I still recall correctly. Okay, so it doesn't matter what instrument. Okay, the principles apply, right? Let's take a look at another one. Okay, so same thing. Okay, you don't need to worry about what time frame, what instrument it is. Just focus on the technical chart. Okay, and ask yourself, is there a clear combination that you can identify from this? Okay, so if you look at this, okay, just focus on the right hand side, the most recent price data, and you should be able to at least quickly identify that, okay, this combination looks pretty similar to this, which is impulse then a crawl. Okay, so every time we see something like this, we know, okay, high chance this is going to reverse. I'm looking for a sell opportunity. Okay, so I hope most of you are getting the direction right. Okay, and this is what happened next. Okay, so price came down, and of course you can see within that move to the downside, there's that impulse down and then a mini correction as well. Okay, but generally you can see price are falling, right? So that's a reversal. Let's take a look at another example. Okay, so this one here again, fairly easy. Okay, all you really need to do is identify with the most recent price movement, the price chart, most recent. Okay, on the right hand side, what combination stands out to you? Okay, and you shouldn't take more than a few seconds because it should be very clear cut. Okay, so again, I want you to practice, right? At least make that decision whether are you buying, selling, or no trade. Okay, so most of you should, in fact, right, I'm fairly confident most of you should get it correct. Okay, you should be able to identify that this combination is an impulse correction. Okay, so you saw the impulse push to the upside and then it starts to go sideways, right? So that's correction. Every time we see this, we know, okay, high chance is going to continue to the upside and therefore it's an impulse push to the up. Okay, this one here is a 15-minute chart. Okay, so doesn't matter time frame. The principles are the same. Okay, so let's take a look at another one. Okay, so I want to show you as many examples as I can before we go to the live chart because they come in variation of form and size. Okay, but that combination of it is about the same. Okay, same thing. Look at this chart. Okay, look out for the clearest combination you can get based on the most recent price data. Okay, again, this one here shouldn't be that difficult. Most of you should get it correct. Okay, you saw an impulse push to the downside and price continue going down, but it's losing momentum. It's a crawl. Okay, every time we see this, okay, high chance, there's a 60 to 70% probability it's going to reverse And whenever I see this combination, I want to focus on buy opportunity. Okay, and this is what happens, right? So that push back up is very, very fast and strong. Okay, so that's an impulse to the upside. Okay, so I hope these examples are clear. In fact, most of you should get, in fact, all trades correct. Okay, all the direction you should get it correct. Okay, so now let me go over to the live chart as of today. Okay, so over here I'm actually using a trading view. Okay, so that's just a charting platform that I use to analyze the market. Okay, now I will get what we're gonna do over here in the application of the live market is I'm gonna share with you the charts and the opportunities that I'm personally monitoring. Okay, and then of course you know, some of these currency pairs or even like commodities might not be, or I would say some of the pairs or instrument that you are looking might not be what I'm looking at. Okay, but that doesn't mean that yours there's no opportunity. Okay, it's just that I focus a lot on currency for trading. Okay, so some of you might be different. Some of you might be trading like indices, commodities more actively. Okay, but the principles still apply. And of course, if you would like to have another perspective, opinion on a certain instrument, right, the analysis of it, do put it in the chat so that I know, you know, and we can go through them as well. Okay, good. I think, okay, so far I can't see any of you typing in the chat. I'm not sure if it's my side or you guys never type anything. Okay, so if you need any pair or you would like to, you know, me to share any other instruments, do that, right? So that I know what are some of the instruments that you guys like to see. Okay, so let's start off with what I'm personally monitoring first. Okay, so actually it's all listed here. Okay, but I'm going to walk you through some of them. Okay, you can see on the right hand side, those are the currency pair that I'm personally monitoring for this week. Okay, when I mean monitoring means that these are the filtered currency pair. These are the potential opportunities that I'm monitoring for this week. Okay, so that's how I do it. Okay, so let's take a look at the very first one is euro dollar. Okay, now this one again, I'm looking at 4-hour time frame. Okay, but the principles can of course be applied to daily, 4-hour, 1 hour, 15 minute, or even if you are looking at higher time frame like weekly, it can. Okay, but to me, why I pick a 4-hour time frame is because 4-hour is a very good balance between swing trading. Okay, so the idea here is I'm not sitting in front of my computer and then trading every day like 2-3 hours. No, I'm not doing that. I'm more of a swing, which means that I'm spending about maybe 30 minutes a day on average, okay, to make a certain trade decision, whether I want to buy, execute my trade, manage it, and things like that. Okay, so 4-hour analysis, 4-hour chart analysis give me that good balance. Okay, so within a week, typically I would have maybe about 3 to 5 trades, sometimes less, sometimes more, but that's the average. Okay, so hope that is clear why I picked 4-hour, okay, time frame. So now let's take a look at this, right? Very quickly apply that principle that we went through, okay, into live market environment. Okay, so again, you realize that I really don't need so many data, okay, because once I can clearly identify a very clear combination that's happening right now, okay, with the most recent price data, I'll be able to make a decision on whether I want to focus on buy or sell. Okay, so this one here is for those of you who are perhaps slightly new to this concept and principle. Okay, you might see it slightly different, but let me explain. Okay, no worries on that. Now this part here, this is an impulse. I think this one, no doubt, nobody will second guess whether this is an impulse correction. Okay, that's for sure an impulse. Very strong momentum to the upside, very fast move to the upside. That's confirmed an impulse. Okay, so this is an impulse. Now this part here is where some of you, okay, might see it as a correction, sideways move, right? Some of you might also start to see, hey, okay, that seems like it can form into a crawl. Okay, so again, there's no right or wrong in analyzing. Okay, at the end of the day, the market is always right. Okay, so if things are not clear, you give time, the market will prove to you which one is right. Okay, so what we do over here is we then plan out. So there are two possibilities, right? So one, this is a correction. Okay, if this is a correction, what will happen? Next move is to the upside. Okay, so that's one scenario. What can happen is also this can be a crop. So it can eventually develop into something like this. Okay, so when that happens, then what we have is an impulse then crawl combination. And when we see this, then the direction is slightly different. We are interested in the sell opportunity. Okay, so as of now, of course, this euro dollar pair is not one of the clearest one that we can say, okay, high chance this is sell or this is buy. For now, okay, there are two possibilities. One is this is a correction, which means from here it can go back up, okay, to the upside, impulse to the upside, or of course this can form into a diagonal. Okay, so hope you can see the application of it. Okay, so this part here, of course, this example of euro dollar is not the clearest. Okay, but let me bring you to Australia dollar. Okay, the other pair that I'm also looking at. So Australia dollar is actually way clearer. Okay, so let me clear off the drawing. Okay, the drawing again is just a visual guidance, visual aid. Okay, it doesn't really affect at the end of the day. Now take a look at this. Okay, so what, again, ask yourself, right? How is price developing? What move is it? What combination can you see? Okay, so look at this piece over here, right? Look at this piece over here. Okay, ask yourself this question: is this fast or is this slow? Okay, so again, you realize there's a lot of overlap, a lot of what I call ding dong. Okay, so that itself tells us a very good hint. Okay, that is a correction. Okay, so now if this is a correction, okay, usually I'll just draw like lines like that, visual guidance. Okay, then you can very quickly see, okay, this is an impulse push. Okay, this push here is very strong. So that's an impulse push, and then after that, what we get, a very slow move to the upside. So momentum is dying down. What combination are we seeing? Impulse correction or impulse crawl to the upside, right? So every time we see this, we know, okay, high probability. We want to focus on the sell. Okay, in other words, this week when I'm looking at Australia dollar, this particular currency pair, I'm looking out for sell opportunities. Okay, so I hope that helps to give you that clarity. Okay, and of course, very important is the confidence to pick a direction and to focus on that direction. Okay, of course, today we won't have the time to go into detail like, okay, where to put your specific entry and stop loss. There are many ways to execute a trade. There's no like the best way. Okay, but at least today, if you can identify with high probability the direction of it. Okay, some of you might use like simple moving average to execute trade. Some of you might use simple pullback, price action, candlestick formation. Some of you might use FIB, some different patterns like harmonic patterns. By all means, okay, all of them work. So over here is the big picture of setting your direction. Okay, so again, this one here gives us that combination of impulse crawl. So I'm looking for the downside. Okay, I'm looking for sell opportunities over here on Aussie dollar. Okay, now this again can be applied, this principle of impulse correction, the combination can be applied to any time frame. Okay, so now let's take a look at the daily chart. Okay, so I play around with like bigger time frame and smaller time frame. Okay, now I want you to look at this move here, right? This is a daily chart, right? Ask yourself, this move to the upside, is it fast or is it slow? Okay, so you realize that, okay, this move up seems like it's not a very high momentum. Okay, compared to this one here, this is huge in momentum, right? Then this starts to slow down as it goes up. So again, this principles, this is a crawl, this is an impulse. We are looking for the downside on the bigger time frame perspective. Okay, principles can also be applied on a shorter time frame. Okay, even like 15 minutes. Okay, so take a look at this one here. Okay, this move to the upside is again very corrective in nature. It's a crawl, a lot of ding dong, right? Now, if you pull up, if today you are familiar with like indicators, MACD, RSI, stochastic, okay, I'm pretty sure 90%, okay, I'm 90% sure that there's already a divergence happening. Okay, so when I understand this impulse correction principle, you really don't need that extra indicator. Okay, because if today you pull out any oscillators like RSI, stochastic, MACD, I'm 90% sure you would see a divergence. Okay, so again, these principles can be applied on any time frame. So 15-minute, if I look at this, right, I wouldn't be interested to buy anymore, because what it means is that this is telling me there's a high chance this can come down first. So I'm more interested in the sell side. Okay, so hope that's clear. Okay, let's take a look at some of the Japanese yen pairs. Okay, so let's take a look at Swiss yen. Okay, Swiss yen has already started moving. Okay, but let me show you what is this. Okay, what is this pattern? Right, so take a look at this, right? As it's moving up, okay, I think the daily is much clearer on this example. Okay, as it's moving up, okay, you look at this here. Okay, you want to ask yourself, is there a lot of overlap? Ding dong. Okay, so ask yourself, how is price developing? Is it developing in a very strong momentum, or is it doing a lot of overlap? Okay, so you realize over here, this is going up, coming down, going up, coming down, going up, coming down. Okay, so that is a lot of overlapping. So that itself is what we call a crawl or correction. Okay, so in other words, I wouldn't be too keen when I look at this to buy anymore. I would want to look for the reversal to come down. Okay, so of course you can see this is on the 4-hour. It's starting to move today. Okay, it's starting to move today. Okay, so this is on the yen pairs this week are pretty clear. Okay, so let me show you some examples. Okay, euro yen. Okay, let me clear the drawing. Okay, so again, look at this chart here. How is price going up? Okay, so there's a lot of corrective move here, right? A lot overlapping. So whenever I say this, I won't be too keen to buy it, okay? But I'll be more interested to wait for the sell opportunity to come down. Okay, if you look at pound yen, okay, most of the yen pairs are actually showing that similar move, right? So again, you look at this pound yen here. This is where the correction crawl pattern is forming, right? The combination is an impulse crawl. So you're looking for that reversal to the downside as well. Okay, if you look at New Zealand yen, okay, it's a slightly different pattern that's forming. You can see this impulse combination with a correction. Okay, so when you see this combination, we know, okay, 60 to 70% of the time, this will continue to the downside. Okay, so it doesn't matter what time frame, again, all this applies. Okay, so same thing in Australia yen. You realize what is it forming? Okay, over here, this move to the upside. Okay, very, very slow. Okay, which means that there's a high chance this will come back down. All right, so again, when I identify this combination, I know high chance price will come back down. I'm more interested to focus on the sell opportunity. Okay, so these are the yen pairs that I'm looking out for. Let me share with you some of the crosses. Okay, like Euro Australia. Okay, let me clear all the drawings. Okay, so same thing in Euro Australia. Okay, on the 4-hour. Again, focus on the most recent price chart. Okay, ask yourself, based on this one here, what is price doing? Okay, how is it moving? Is it going up very fast, or is it slowing down? Okay, and of course, this move here, you can see a lot of overlap, right? Ding dong. Okay, that's the characteristic of a correction. In other words, this is a crawl. Okay, this move up is where the impulse is. So every time I see this combination of impulse crawl, I'm more interested in the downside. Okay, so this one here, for Euro Australia, I'm focusing on the sell. Now, if I bring you to different time frame, right? Okay, so this one here is a little bit advanced, okay, but we are combining this concept and principles still the same. Okay, just that you apply it in different time frame. Okay, so over here, if you look at this, right, the daily. Okay, so this move down here is pretty fast. Okay, and what is happening right now is this is just going sideways. Okay, so again, this is actually what we call an impulse correction. Okay, so you're expecting another move to the downside based on this combination. So when we look at 4-hour, okay, the 4-hour time frame is telling us that the combination is coming down. And then on the daily time frame, the combination is also telling us it's coming down. And of course, what we can do is we can even look at like 1 hour and see what the chart is telling us on the 1-hour chart, on the 1-hour time frame. Okay, so on the 1-hour time frame, okay, you can see as of now, this one here is a bit choppy, right? Not clear. Okay, so what it means is that, okay, I know daily is telling me that the direction is down, 4 hours is telling me the direction is down, but if 1 hour is not clear, there's no clear sign of it, then if today you are a multi-time frame trader, okay, your combination over here is that you have a higher time frame daily and 4 hour telling you to sell, look for sell opportunity, but the 1 hour is not clear. Okay, then what it means is that maybe you don't want to execute that trade first. Okay, you want to stay away, wait for a clear opportunity, a clear combination on a 1 hour chart. Okay, so that can be the application of it. Okay, let's take a look at pound Australia. Okay, pound Australia is very clear on the 4 hour. Okay, very clear on the 4 hour. Look at this combination. Okay, so if I erase all the drawing, right, just look at this combination. Okay, what is price doing here is actually very slow, is moving sideways. That's a correction. What is price doing previously? It goes up very fast, very strong. Okay, so this combination is basically an impulse correction. Okay, for visual purposes, sometimes I just draw in the trend line, right, to visually identify, okay, this is what happened. Okay, so nothing too fanciful about it. Okay, when I draw in those two lines, every one of us right now can see, okay, this is a correction, that's the impulse. Okay, every time I see this move, I know there's a high probability the direction is going to continue to the upside. Okay, so pound Australia, this currency pair right now is one of the clearest opportunity that I'm personally monitoring. Okay, of course, for those of you who are also trading on this, you can keep an eye on this pair. Okay, so again, same thing, impulse correction. When I see this combination, I know. Okay, can I be wrong? The answer is of course yes, right? But I know 60 to 70% of the time, whenever I see this, I know the direction is likely gonna go higher. Okay, so I'm actually just capitalizing on the probability to the upside. Okay, so this is pound Australia. Another one, okay, that you can keep an eye on is pound New Zealand. Okay, so same thing. If I erase everything, right? Again, you ask yourself this question: how is price developing here? Is it going up very fast, or is there a lot of overlap, a lot of ding dong? Is it a correction? Right, so same thing, you look at this, how price is going up, there's a lot of overlap, right? So this entire piece here is basically a crawl. This move here is an impulse, very clear, right? You can look at the difference. Okay, look at the difference between this move to the upside and this move to the upside. Definitely this one here has lost its momentum. Okay, so every time we see a combination like that, I'm more interested in the downside. I'm no longer interested in buying it because I know eventually if this continue to go up, okay, I will let it go. Why? Because the upside is very difficult to trade. I would rather focus on this move to the downside. Okay, so pound Kiwi, pound New Zealand, I'm focusing on the sell. Okay, this setup is also very clear. Again, whenever I see this, I'll just drop two lines for visual purposes. Okay, so that's how it looks like. Once I draw this line in, very clear cut. Okay, so that's just basically for visual purposes. Another one that is very clear is actually New Zealand Swiss franc. Okay, so let me remove the drawing. This one is clear, is very clear on the daily chart. Okay, now ask yourself, how is this forming? Okay, if today I put in that line, you'll be able to see, right? So I just duplicate that. Okay, this is what? This is like a correction. Okay, it's going down, but it's not as fast as this move to the upside. Okay, again, look at the duration of this move. Okay, very short. Look at the duration of this move here, very long. Okay, so relative comparison, this move here is a correction, this move here is an impulse. Okay, so again, when you look at this combination, impulse, correction, we know high chance this can go and continue to the upside. So I'm more interested in buying this pair. Okay, New Zealand Swiss franc. Now, if you look at the 4 hour time frame, it's also very clear. Okay, what is price doing recently? Ask yourself this question, right? How is price coming down here? It starts to seem like, okay, it's losing its momentum. Again, I know 90%, I'm pretty confident that if you pull out an indicator like RSI, stochastic MACD, you will see a divergence happening now. Okay, so when that happens, you know this is a crawl. It's a slow momentum move to the downside. What it means, high chance reverse to the upside. Okay, so if the daily tells me, okay, look for buy, 4 hour, look for buy, good thing, because both align, both confluence. okay, and then what I'll be looking out for is, you know, my entry trigger. Okay, so again, there are many ways to take a trade. Okay, you can trade a breakout, you can trade a retracement, you can trade a Fibonacci, you can trade candlestick pattern. There are many ways to execute it. Okay, so today we won't go into that detail of how to execute it because you might have various techniques to enter a trade. Okay, all of them work. Okay, at the end of the day, again, as long as you are disciplined enough to manage your risk, you'll be fine. Okay, so these are some of the currency pairs. Those that are clearer, okay, as of now, as of today, sharing those that are clearer are your yen pairs plus your pound Australia and your Kiwi Swiss franc. Okay, of course, pound New Zealand as well. Okay, now can this apply to commodities? Okay, the answer is yes. Okay, so I'm actually in SLV, okay, which is actually a silver ETF. Okay, so of course you can substitute this with XAG USD, which is silver, right? And recently silver and gold has been like the hot topic, right? Everyone is talking about it because of that huge rally. Okay, now can this principle be applied to pick up the direction? The answer is yes. Okay, so let me show you this. Okay, I actually entered this SLV, this trade. Okay, I entered two positions before that huge push. The first position was somewhere around $14. Okay, so you can see my drawing over here. Okay, this is where you can see, right, V-shape formation. You don't touch it, you don't enter because of the V shape. But right after the V shape, what I see, correction. Okay, see this correction, right? So that correction tells me, okay, good time. The direction is going to continue to the upside. Good. Okay, so what happened next? Correction again. Okay, so the same principle. And then what happened next? It goes up. Okay, so now the question is, what is it happening here? Okay, so again, if today you only see an impulse, okay, let me bring you to this, right? Today, if you only see an impulse move in the chart, don't do anything. Okay, because the worst thing to actually enter a trade is right after an impulse. Okay, why I say that? Because I want you to just imagine for a moment, right? Right after impulse, what are the combination you can get from here? Three things, right? Again, three combination. One, it forms a correction. Okay. Two, it gives you an impulse down. Three, it crawls up. Okay. Now, none of this is gonna be in favor to you if you are buying it, because number one, if you buy here, this move here, you're gonna suffer a drawdown. It's not easy to manage psychologically. This move here will probably get you stop out. Okay, you're gonna get a stop loss. This move here will probably be making you very anxious because, you know, oh, you see a little bit profit, you see your profit dissolve, you see more profit, you see a profit dissolve, you're gonna be very worried. Okay, so any of this situation or scenario is not gonna help you at all. Okay, so in other words, remember that every time you see an impulse, don't jump into any trade. Okay, I hope none of you are actually trapped in that gold rally. Okay, because if today you bought after that impulse when the news starts coming out, you are probably suffering some losses right now because of that retracement, right? So right now, if you look at the gold and silver chart, what it's doing is slowly forming a correction. Okay, if this continue to consolidate like that for, I would say, maybe another couple of days, by the end of this week, okay, if this forms a correction, then today, you know, whenever you see an impulse correction, you know, okay, the next direction very likely is continue going to the upside. Okay, and that is the time you look out for buy opportunity, not when the impulse has happened. Okay, so I hope that's clear. Okay, so this application on commodities can be done also. Okay, now gold and silver has been moving up very strong, very fast. Okay, so the question people also ask is there still more upside to gold and silver? The answer is yes. Okay, the answer is still yes for me. Okay, my view here is that yes, the precious metals still has a lot of room to continue the upside based on not just technical but fundamental reason, right? Because the Fed has been printing money, the weakening of dollar, and of course that fundamental perspective will play out much longer term, right? So gold and silver still have much upside. Okay, but personally, I would focus more on silver compared to gold. Okay, now in terms of commodity, I also want to share with you another example on natural gas. Okay, so this one here again, you can trade it on CFT or you can trade it on ETF, up to you. Okay, but same principle, same principle. Okay, let's take a look at the chart. What is this move here? Okay, so you saw a mini impulse. Okay, so a mini impulse goes sideways and another push. Right now, if this forms a correction, okay, you get a very clear combination of impulse correction. You want to look for the upside. Okay, so why am I looking at natural gas? Okay, again, why? Because if you if I zoom out a little bit, right, you look at where the price of natural gas is right now. Okay, the lowest point it hits is somewhere around $1.50. Okay, so it's very, very low because in commodities like that, right, where that industrial usage, it can never go to zero because it doesn't make sense, right? Their demand to it is never going to go to zero. Okay, so over here you can see, okay, if price is already like really, really low to its production value, to its production cost, it's a very good time for you to start monitoring the commodities market. Okay, if you take a look at XAGUSD, right, silver. Okay, back then it dropped all the way until somewhere around close to like $10–11, right? Again, that is like the production cost value of silver, so it can never go zero. Okay, so that becomes a very good time for you to start monitoring the commodities because it's like really that low already, right? So the only high probability direction is to the upside. Okay, so commodities you can actually play out like that. So this opportunity right now that I'm sharing with you today over here is can pay attention to natural gas. Okay, now I'm not saying that today you go and click the buy button. Okay, I'm saying that there's a good potential for natural gas because we are already very low. Okay, and pay attention to it, look for the upside. Okay, so these are some levels of commodities that I'm monitoring, and I'd like to share this opportunity with you guys as well, right? So this is gold chart, right? XAU/USD. Okay, this is on the daily time frame. Again, you can see right now what's happening. We have an impulse push, right? So again, the principle of impulse correction. You have an impulse push to the upside. Don't buy at the end of it. That's where the news comes in, right? That's where the news comes in. If you buy on that, that's what happened. V shape. You get trapped. Okay, and then those that trade on impulses, when this drop, then they say, okay, now it's going down, and then what happened? It V-shaped back up. Okay, so never jump into a trade at the end of an impulse. Always wait. Okay, when you see an impulse, wait. So right now, what you see on this gold chart is basically impulse combination. It's a V shape. Look at this. It goes up, it comes down very strong momentum, it starts to go back up very fast. Okay, it's a V-shaped formation. Every time you see this combination, stay out, be patient. Eventually the market will develop into a combination that tells us what it can happen. Okay, now to take this a little bit further, right, so that you guys can see the application from here, how you extend that application. Okay, so now this is an impulse down. Okay, this is an impulse up. Okay, it's somewhere in the middle of this impulse down right now, right? So again, you only have a few possibility of how price can eventually develop, impulse or correction. Okay, so from here, it can of course starts to form a correction here. Okay, and if that happens, then we all know, okay, this is gonna look for the upside, right? So that's one possibility. What can happen is, of course, this can also come back down. So what it forms, another impulse, you get V-shaped combination, don't trade. Okay, and what are the third possibility? This one here starts to form a crawl. Okay, and when you see that, then you know, okay, this is a good combination that I know I can identify and familiar with. I know this probability is to the downside. Then you have a trade. Okay, and of course, some of you who have some experience in technical analysis might start to combine a little bit things like, okay, double top, right? And of course, you have this combination of what we talk about today, right? You can stack those things up together as well. Okay, so this part here, again, with a simple knowledge and this skill set of identifying and differentiating what is impulse and correction can actually be very powerful when you apply it to technical charts. Okay, this technique here that I've just done just now, right, is called forecasting. Basically, you can pre-plan what are the potential scenario of the market. Okay, in terms of like scenario A, this will happen, B, this will happen, C, this will happen, and you can actually pre-plan way ahead of it, okay? Because like this, if I see this, then I know, okay, I can look for short opportunity at this very top, okay? Because I have the double top, I have this combination that I'm familiar with. There's a high chance this will come back down. I can pre-plan for it, okay? I can also say this, okay? From here, this is a V shape. So if this starts to do a correction like that, then I can look for a buy. Okay, so I can pre-plan myself, right? So if let's say this happens, then what I'll do is I'll look for the buy trade to the upside. Okay, so I can prepare myself before it even happens. So that's what we call forecasting, right? So I hope that also gives you some insights into it. Yeah. Cool, right? So if you look at some of the, I would say, stocks, okay, maybe some of you are interested, right? Indices and stock market, the principles still apply. Okay, this is actually Japan. I'm looking at Japan indices. Okay, so you can see my drawing here, right? This is the trade that I'm looking at, right? This is Japan indices. So it's Nikkei, right? It's Nikkei. You can take a look at this as well, right? Same principle. We get an impulse and then we get a very nice correction and we are expecting another push to the upside. Okay, so again, I'm looking at this right now. I'm not in yet, okay, because already what is happening? Impulse. When I take a look at this, this was already there, okay? So at the end of this impulse, you don't jump into the trade here. You wait for a correction to happen, okay? That's what I always want to see. Impulse, then correction is a very clear combination, then I'll take the trade. Okay, these are indices. If you look at stock, right? So some of the potential stock to look out for, this is Intel. Okay, I'm waiting for this. Of course, I'm looking at it on a more on a higher time frame. Okay, because stocks sometimes you don't trade them intraday like that. Okay, so for me, I don't trade them intraday like that. Okay, so if you take a look at Intel, okay, what pattern is this forming? Okay, what combination is it forming? Okay, ask yourself, how is price developing here? Okay, is it very clear momentum or is it a lot of overlap? So same thing, you realize that, okay, ding dong, ding dong, ding dong, this is definitely a correction. Okay, and this correction is slowly going to the upside, and then your impulse was here. Okay, so again, what combination are we getting? A crawl, which means that this likely can come down first before any push to the upside. There's a high chance this will come down first, right? So in other words, if you're looking for Intel to invest into Intel, right, then maybe not the time yet. Okay, so this is something that you can apply technical analysis to help you, okay, in determining the timing and the direction. Okay, I hope this sharing so far has been clear. Okay, I still can't see any of the chat coming in. I'm not sure if any of you actually type anything. Okay, so yeah, I'm not sure any of you actually type any questions. Okay, but I'm pretty sure you guys have question. Okay, because usually during sharing session like that, if there's no question, there's only two things, right? Number one is like whatever explained is super clear, which I hope. Okay, why I can't see? Maybe you can. Yeah, okay. So maybe can type it out for me because I really can't see the question. Okay, good. So definitely, I'm sure there's question, right? So good. I thought, how come there's no question? Cool. Okay, so we'll give a few moments. Then I'll address your question. Okay, so Jeremy actually asked, how do you identify the end of a correction? Okay, so let me address the question by Jeremy. Okay, very good question. How do you identify the end of the correction? Okay, so let me use the chart on the. Okay, of course today I'll use some example that is clearer, okay, and easier for you to understand. Okay, so we use pound Australian. Okay, over here, okay, let me put up a quick disclaimer first that to identify the very end of the correction, you need to also understand a little bit of the understand a little bit deeper into the principles of Elliott wave. Okay, but today I'm going to share with you a very simple technique that I simplified. The complexity of Elliott wave, I simplified it so that you guys can immediately apply this principle. Okay, now one quick tip for you to understand the end of the correction, okay, is that always anticipate. Okay, price might not give you that, but always anticipate 3 move in the market. Okay, now when I mean 3 move, you can see this is 1, this is 2, okay, this is your 3. Okay, so it looks like that, 3 move, 1, 2, 3. Always anticipate 3 move. Now, of course, you can also identify within this, you can see 1, 2, 3. Okay, this forms your 1. This is 1, 2, 3. This forms your 1, and then of course right now this might form 1, 2, 3, and this might form your third one. Okay, so the internal of the market move, most of the time it tends to move in 3. Okay, again, if you just pull back a little bit, okay, this is an example, 1, 2, 3, 1. This is a little bit like this, 2 and 3. Okay, so this is a quick tip. Okay, but again, it's not like the perfect, it's not going to happen all the time, but we as traders always anticipate 3 move. Okay, so in order for you to kind of like know or kind of project that, okay, this correction is likely ended or completed, okay, anticipate and see if you can identify a very clear 3 move, right? So over here you can see this is very clear, 1, 2, 3, right? Of course it can still do this, and this is still your 3. Okay, this is where today the simpler version is to really identify that. Of course, you have like the more advanced stuff, like you can put in your fib and things like that. Okay, so like you can anticipate like equal movement, right? So this is based on principle of Elliott wave, like this move here and this move here will be equal, so you're anticipating this. Okay, so this part here, you know, is a little bit advanced, but today the quick tip for all of you is to look out for 3 move in the market. Okay, so most of the time when you see a combination impulse, the correction is 3 move. Okay, so that's a quick tip. So when you see 3 move, then likely this is done and you are ready for the move to the upside. Okay, so I hope that's clear in terms of like the simpler version of it, right? And I'm using pound Australia because this is very clear. Okay, good. Let me look at the next question. Okay, so I have a question from Raman. Okay, Raman says, ask the question on, does this apply to oil and gas? Yes. Okay. In fact, just now we take a look at natural gas, right? So that's actually in commodities. If you look at WTI, which is the oil market, that applies as well. I think I used the wrong chart. Okay, so it applies into all technical chart. As long as you have a price chart, you can apply this. Okay, so same thing, you can take a look at oil right now. Okay, look at how price has been moving recently, right? Very, very corrective, very slow, there's no momentum. Do not buy into this, because again, if you buy, it's very difficult for you to trade to the upside. Okay, so same principle can be applied. Okay, so I hope that's clear. Another question from Charlie. Okay, if you wish to learn more about Elliott wave to swing on stocks, could you point us to the right direction? Okay, so if you are interested to further studies in Elliott wave, right, the one book that you really need to pick up is called Elliott wave principles. It's by R. Nelson. Okay, so pick up the book. Okay, the principles of Elliott wave is not so straightforward. Okay, so I actually studied Elliott wave some time back, and then halfway through I didn't really get it. I took a break, I tried different strategies, and then I come back to it. Okay, so I understand that Elliott wave is not one of the simplest or easiest way to pick up, but it's one of the very powerful technique to look at technical charts. Okay, so for Charlie, the one good book to focus on for Elliott wave, if you want to further studies, is actually the Elliott wave principle, the book title called Elliott wave principles. Okay, so that's a very good book. Good. So Vico has another question, right? So Vico here says, do you apply any other indicator when you enter the trade? No. Okay, let me show you. Okay, so very good question, because a lot of people likes to, okay, but I'm not saying that the indicators will work, but for me, I don't really look at those. Okay, just to show you how I look at charts, right? Did I remove all my drawing on the charts? Let me load up some charts. Okay, so I want to show you that my charts really, before I remove them, like just now for some examples to show you, right? My charts really look just like that. Okay, so just a very quick sharing on my entry technique. Okay, so my entry technique might not be the best and might not be suitable for everyone. Okay, but I look for breakout. Yeah, look for breakout. So that's a very simple one, right? So what does breakout means is that, you know, if today I'm looking at this, I'll be looking at if price breakdown, then I'll be entering on that break. Okay, so that's what we call a breakout. Okay, so I don't really use any indicators, but of course you can use indicators to assist you. Okay, so some of you might use maybe like a Bollinger Band breakout. Okay, some of you might use maybe RSI or you know, or maybe RSI overbought or oversold. Then you look for the entry, or you are using like simple EMA crossover to trigger your entry. It works. Okay, so all these indicators does help, but for me, I don't really look at that. Okay, so you need to eventually, for Vico, you need to eventually find out which approach, okay, you're comfortable with, because at the end of the day, trading, right, it's not a one-size-fits-all solution. Okay, some of the approaches might be very comfortable with me, but to you, you might find it maybe uncomfortable, or you might find a better one that fits you. Okay, so it's a process of discovery as well. It's definitely a journey, so this is something that you want to consider. Okay. Bartley has a question, Yo, right? Yo has a question, which is the good point to go into the trade after identify the trend? Okay, so this actually is very similar to the question by Jeremy, right? When how to identify the end of the correction. Okay, so the idea here is if you're applying this principle to enter a trade, okay, what you want is you want to enter the trade closer towards the end of the correction. Okay, so if I bring back this very simple example on pound Australia, right? We don't want to enter too early, because if price is still gonna be in the correction and then you enter the market, right? Then you realize that it's very challenging, because psychologically you would see some like winning, some losing, some winning, some losing. You might be affected by that trade. Okay, so you want to enter the trade as close to the end of the correction, but again, we as traders can never know for sure that the correction ends. Okay, so what we can do is we can pick up tips and hints of probability of it ending. Okay, so one tip again is that if you see three wave, okay, you know, okay, this is likely done. Okay, and what if I'm a breakout trader? Then I'll be waiting for price to break out here. Okay, and my trigger will be this point here. Okay, so if I only, okay, for example, okay, if price back then, okay, was like that. Okay, so I know that, okay, maybe this part here, okay, not so clear yet. Then what I'll be doing is I'll be waiting, give the market some time to prove to me what is it likely going to do. Okay, again, patience is a very, very powerful tool for traders as well. When things are not clear, you are not forced to take a trade. Just wait on sidelines and let the market show you much clearer things. Okay, so I hope this is answering that question as well, right? What is a good point to enter the trade is really wait for the end of the correction. You want to wait until, okay, very clear, the correction is there, it's likely ended, and then you enter the trade. Okay, there are different entries techniques as well. Okay, Milton asks any particular indicators to use. Okay, so I don't personally use it, but if you ask me what is one of the, maybe if I were to recommend, right, one indicators for all of you to start using, I would say pick up the skill set of RSI, or in fact divergence. Okay, look out for divergence. Okay, so let me show you a very quick understanding of what divergence is, so that all of you also understand what I mean. Okay, let me use the chart on, okay, maybe Australia. Okay, now what is divergence? Okay, so of course to identify divergence, you can use RSI, you can use stochastic, you can use MACD. Okay, but for me, you know, if today very simple, you use RSI. Okay, again, doesn't matter what period you're using. Okay, 7, 14. Again, to me, those are just like trying to pick like the best, but there's no such thing. Okay, so what is divergence? Very simple, right? Look at this, right? Price is going up, but your RSI is coming down. Okay, so that is a divergence, right? And most of the time when you spot a divergence, it means that momentum is losing and you are looking for the trade to the downside. Okay, so when I first started trading, okay, this indicator of RSI to spot divergence kind of like helped me quite a bit. Okay, but eventually, as you get very familiar with the charts, Okay, looking at price movement, you realize that you don't really need this, but I know that there's a divergence there anyway. Okay, so that's why I can easily use this chart as an example to show you what divergence is. Okay, so I hope I answered that question, Milton. If you are looking at one indicator used, it will be the divergence, RSI. Okay, Derek asked, what are you looking for bullish breakout for Japan Nikkei index? Okay, again, this one here, if you're looking, very good question. Okay, so let me go back to that. If you're looking at technical charts, right, then there's a very clear reason, because we are looking at impulse to the upside, and then now it's forming a correction, right? So let me take away my RSI. Okay, so from a technical point of view, very clear cut, right? So we get a push to the upside, and then it's forming this correction, and we are expecting a continuation to the upside, right? So every time you see this combination, we are expecting it to push higher. Okay, so for that reason, the technical perspective, I'm looking for the buy direction. Okay, but of course, there's also the fundamental reason to it. Okay, so I actually combine a bit of both. The fundamental reason here is that, of course, right now we all know that majority, or in fact, almost all the central banks are printing money. Okay, and when there is increase of money supply, the money will eventually go into some market. Okay, and naturally, right now, a lot of inflow actually went into the precious metal. That's why we saw the rally in gold and silver. Okay, but of course, not all money is going to go there, right? Eventually, there will be some rotation of money supply. Okay, and likely this will flow back into your indices. Okay, and for that reason, the fundamental reason, I'm also looking at index, right? Indices. That's why that's why I'm monitoring this, because it's recently just broke out of it. Okay, so there's the opportunity to actually get in. Okay, so I hope that answered the question. Trader Lin asks, when do you usually trade FX market? Very good question. Okay, is it Asian, London, or US, or is it similar? No. Okay, so for me, FX, for those of you who are trading FX also, this is a good knowledge to have. Most of the time, the impulse is gonna come between London and US session. Okay, which means that if you are now in Singapore or Malaysia, right, basically Southeast Asia, the time zone between London and US is actually somewhere between 3 p.m. in the afternoon to somewhere around maybe 8-9 p.m. Okay, so that's the prime period where impulses tends to happen. Of course, not all the time, but that's usually the time happens, right? So what I do, okay, is that during the Asian, which is our morning to early afternoon, that's where I analyze the market and I make a decision if today I want to put in a pending order, a breakout trade. Okay, so that's how I usually do it. And during the London and the US, it's basically just the monitoring stage, which means that I want to just monitor, okay, do I have a trade get in? Do I want to manage my trade? That's about it. Okay. She can ask, do you use daily, then 4 hour and 1 hour in that order to analyze the movement? Yes. Okay, so it's actually very good to have multiple time frame. Okay, so what I do is I look at 3 time frames that I want to find coincides with each another alignment. Okay, so 4 hour daily tells me sell, 4 hour tells me sell, and then 1 hour also tells me sell. Then that's a good opportunity, good timing as well to focus on that. But if they give me conflicting direction, that's where I want to stay out of the market. Okay, so yes, right, I look at multiple time frame. Okay, Charlie asks, how do you identify the end of a crawl to plan for shorting? Okay, very good question. So just now we have a question on correction, right? How do we identify the end of the correction? In terms of crawl, hey, the expectation is slightly different. Okay, so let me bring you to one example. Australia dollar for the crawl, right? Australia dollar, the crawl is very clear cut. Okay, so just now we shared that for correction, you want to expect and anticipate 3 waves, right? So most of the time market move in 3. But if you're looking at crawl, then likely you want to anticipate 5. Okay, so again, these are actually based on principles of Elliott wave, right? I'm just simplifying it. Okay, so what I mean by 5 is this. Okay, it's gonna look like this: 1, 2, 3, 4, 5. Okay, and this forms your crawl. Okay, so right at the top, you're gonna see 1 time, 2 time, 3 times, and then that is the prime time for you to focus on it. Okay, so again, it's not all the time like that, but we always anticipate this to happen. Okay, of course, before that, that's your impulse, right? So you want to see at least 3 times at the top, right? So this is actually an Elliott wave pattern, just that I simplified it, right? You don't have to worry about the complexity of it, but look out for that 5 move, the 3 at the top. Okay, now if I go down to Australian dollar, right? So take a look at this, right? If I draw this in, okay. Now, how many times do we have here, right? So this might be 1. Okay, so this is very close. So I would just consider that this is like that, right? And then you anticipate 1 more here. Okay, so again, this is where this happens. Okay, so this is for crawl, and of course, today, if you're familiar with technical pattern, this is also what we call diagonal. Okay, this is also what we call diagonal, and when that happens, this is where you look for the short. So the part where you want to look for it, where it's gonna end, okay, is the 3rd time it touched at the top. Okay, so it's not all the time it's gonna do that, but as traders, we just anticipate that. Okay, so hope that's clear. Sean has another question. So using this strategy, should we ignore market noises? Now, Sean, I'm not sure when you put in there market noises. I'm not sure exactly what you're referring to, but you know, there's really no noise per se in the market, okay? Because there are many factors affecting the financial market, right? Many factors affecting the price. Now, if you're talking about noise like, oh, headlines on the news, right? Then yes, I would say those are noises, right? So for example, recent times you start to see like Warren Buffett starts to buy into like gold mining companies. You know, gold hits all-time high, and then some article talks about how it can go even higher and things like that, right? So those to me are noise, because those are, you know, things that not gonna happen in your trade plan. Okay, but if today you're talking about, oh, if you know, suddenly the price starts to move quite volatile, okay, there are reasons to that, okay, and that is really not categorized as noise to me. There are reasons behind why suddenly the market becomes very volatile. There's also reasons suddenly the market becomes very quiet. Okay, so there's actually a fundamental reasons behind it. Okay, I wouldn't categorize that as noise. But if today, okay, you are relying on news article, you are relying on, let's say, you know, what Warren Buffett does, and it's being reported in the news, and then you use that to make a decision on your trade, then you want to be very careful on that. Okay, so I hope that's clear. Okay, but of course, today you also want to be very clear-headed in a way that when you are looking at the chart, you are analyzing it from a technical perspective, technical point of view, right? So that's why we call it technical analysis. But at the same time, you also want to understand and acknowledge that there are the fundamental forces, there are the sentiment forces that can affect the price movement. Okay, so some traders would say, okay, I only look at technical to make a decision. Some traders would say, I want to have technical fundamental sentiment, right? Again, there's no best way. You need to find which you are comfortable with. Okay? But I would say that if you only look at technical, can you make money? The answer is yes, right? The answer is yes, because at the end of the day, you just need that edge, that extra advantage over the market. Any strategy that can give you that, you can make money from. Okay, so I hope that's clear. Good. Okay, so I was told that there are still many other questions, but because of time, we won't be able to answer all of them. Okay, so what I would like to then share with you, the last part over here very quickly, okay, is that I think CMC has recorded this entire webinar, right? So they will send out to you perhaps once this recording is up and things like that. If today you want the slide deck of it, I also prepared an automation so that you can download it. Okay, so I don't have to send to you manually. You just need to go over to this website here, and then you'll be able to download today's slide deck. Okay, and of course, those of you who would like to have some more questions clarified, feel free to also reach me through social media, right? Facebook and Instagram, both are okay, right? So if you have any questions, you can reach me there as well. Good. So once again, I'd like to thank CMC for having me in this webinar, right? Giving me this opportunity to reach out to you guys, sharing with you my experience and journey. Hope you guys really take away something from today, okay? And actually able to help you in your own trading journey. Okay, so that's really my objective. Okay, good. With that, then I'll end off this webinar here. good to see you guys, right? So good night and bye bye.